It's Brian Preston, the Money Guy.
All right. Okay, we've talked about some things that are happening with inflation as it relates to housing, as it relates to cars. Well, one of the things people want to say is, okay, I've got those things figured out. What are the other ways that I can protect myself? And again, if you're looking on social media, if you're reading articles, if you're staying in financial news, financial information, you may be hearing something like, hey, real estate or gold or Bitcoin. Those are the only ways to protect yourself against inflation. If you're not doing those things, boy, you're not going to be able to keep up. It's going to run away from you. I don't know that I completely agree with that assessment.
Well, yeah, let's look. First of all, real estate, most of us, if you already own a home, you already have some protection, the fact that you already own a house. But if you're thinking about buying real estate from an investment or an inflation hedge, this is a scary time to be thinking about that because of the purchase price is running away from us. There's all kind of concerns there. Plus, you got to have the deep enough pockets that cash flow wise, if you get squeezed, if markets do correct or we have recessions, you can cover no matter what comes your way. I think about gold and Bitcoin. Both of these have limited supply, and they're supposed to be better at protecting against inflation. But these are also elements and assets that don't have innovation, don't have dividends, don't have rent income. When you buy them, they basically sit there, and the only way you make money is if somebody pays more than you paid, which in inflationary periods does have potential, but it's a little concerning. There has to be a better way. And that's why we always talk about the biggest inflation hedge that is so in front of your eyes, but people just don't cover it, is financial investments, just buying index funds. You'd be surprised buying into the progression, the innovation, the technology of our modern world might be a better long-term inflation hedge than just these traditional things that have been shared.
And so again, let's go back in time and let's look at the last inflationary period that we saw. If you look from 1978 to 1983, so we're kind of going to shrink that window down, you can see annual rates of inflation relative to returns of the S&P 500. So in 1978, for example, inflation was 7.5%, S&P made 6.4. 1979, inflation was a little over 11%, S&P made over 18.5%, so on and so forth. What we think is interesting is if you look through this 1, 2, 3, 4, 5, 6-year period, $10,000 at the beginning of that period would need to have $16,000 at the end of that period to have the same purchasing power, to maintain that. Well, if you would have taken that $10,000 and just invested in the S&P 500 at the end of that 6-year period, you'd have $24,000. So not only did you maintain your purchasing power, you actually improved your purchasing power over that time. This shows us that certainly during a small window of an inflationary time, equities or companies or financial investments, ownership in companies is and has been a great hedge against inflation.
But Bo, you just said it. That's 6 years. That's a high inflation period historically. What's the rest of the story if you expand this period even longer?
So if you look from 1978 all the way through the end of last year, 2021, inflation has averaged about 3.5% per year, but the S&P 500 has returned 12.4% annually. There are two really big takeaways that I would take from that. The first one is we just showed you from 1978 until 1983, inflation averaged double digits. But when you stretch it out over the longer term, reversion to the mean does take place, and we've seen a 3.5% average inflation rate. So just know that this too shall pass. We don't know what inflation is going to be over the next 1, 2, 3, 5 years, but over the long term, we can say that it's fairly comfortable and confident that it's going to revert somewhere close to the mean. Even in that context, returns on the S&P 500 have been incredibly healthy, 12% annualized over that, 20, 40-ish years or so. It has been a great way to not only protect the purchasing power of your dollars, but actually improve the purchasing power of your dollars through time.
So this is the part, remember the car ride into work this morning? I was thinking about, man, I really want to make sure that I hone in on that financial mutant mindset, or how do you have that inflation vision? And I was like, how do you spot the risk and opportunities? And I want to go a little deeper to kind of close this out, Bo. First of all, let's talk about assets. You know, the big thing, and we talk about this on so much of our content, is making sure you understand the why when you make decisions, that they align with your goals, where you're trying to take your financial life. All that is so important that you got to have it tied down. And then how do they hold up in these unique times? Because it is interesting. Stocks, as you just covered, they do very well during inflationary periods, but it's also important for financial mutants to understand, well, what's other things, other assets I might own? We know real estate does well in these times, but bonds, because of rising interest rates to battle inflation, they might struggle a little bit. They're going to sputter and have a hard time getting traction. Know that going in so you can, like you said, no risk, but opportunity. But pivot that now, and I want to leave this for you, Bo. Talk to us about debt. I talked about the asset side of this, but let's talk about debt. How does, during inflationary periods, how do you think about debt a little differently?
Yeah, so one of the really unique things is that if you are a debt carrier, a debt holder, a debt owner, as inflation happens, it actually makes the value of that fixed debt decrease. It's easier to pay back debt as inflation happens, certainly if you have a fixed rate. So if you're someone who has a mortgage, I don't know, at 2.5%, 3.5%, and we are entering into an inflationary environment, and you've been on this track where you're trying to get debt free and you're trying to pay off the house, perhaps you ought to think about, is paying off my house, is that the best way for me to approach protecting myself from inflation? Or based on my age and income and life circumstance, might there be a better way for me to still accomplish that goal, but accomplish it through a different means moving forward?
Yeah, and then I was even thinking about in terms of like your buying decisions, because so much of this inflation show is because like housing purchases. I think a good exercise for anybody that's trying to make that decision of if I'm buying a house, debt, that's an asset, buying the real estate, but there's also usually a debt component that comes with it. I want you to understand there's some relationship between the housing purchase price to also where interest rates are. So when you're making this decision, I want you to run your analysis with your mortgage at 3.5%, 5%,
That's great.
and 6.5%, because, and then you can put on the buying power of the house. Yeah, maybe there's going to be a 10% flux on the purchase price to the low, to the high, just because we are in this unique inflationary period. But I think you're going to be shocked to see the more interest rates go up, the more affordability of that house goes down. So a lot of you are saying, well, man, if anything, that means, yeah, housing prices, they kind of can be justified because of the low interest rates. But that's where I get, whoa, danger, Will Robinson, because this is, I don't want you thinking leverage. This is the intoxication that comes from leverage, because people, I can already see it in the comments. You're probably like, let's just go take a bunch of loans. Let's go buy houses. Let's go buy some investments in the S&P 500. What could go wrong is that leveraged growth, and that's what we're talking about when you're doing mortgages. That's what we're talking about when you do margin loans and other type of investment loans to go buy those leveraged assets. Don't lose track of the risk.
And there is a difference in a good, well, sound, thought out plan and getting yourself way out ahead of your skis. Like you just heard us say, bonds are an interesting thing in a rising rate inflationary environment. Does that mean that we are proponents of designing portfolios with no bonds in it? Absolutely not. We think you have to think about them differently, and you have to look at different areas of the market to make sure that you have a portfolio that is well structured and doesn't put you too far out on the risk spectrum, but takes into account that rates are likely going to rise. Because yields on savings and checking accounts are so low right now, does that mean you shouldn't hold any cash or any emergency reserves because you're going to lose money to inflation? Absolutely not. Yeah. Those things are there for a very specific purpose. And you should have a good plan before inflation starts. You should have a good plan during a hyperinflationary period. And your plan should remain good even after that inflationary period has passed. If you're trying to move and maneuver and time it, I worry that the markets and the economy can be incredibly unpredictable, and you're setting yourself up for a fool's errand to try to time it just right.
And that's why it's so important to have a balanced approach. I don't want you getting caught swimming naked.
That's right.
And that's what happens if you use debt the wrong way. We've tried to give you all the building blocks of seeing through the madness that's out there in social media, but also having that inflation vision that a financial mutant has, where you can see that risk, you can see that opportunity. If you haven't, I have to encourage you, go use our free resources. We are trying to load you up and fulfill the abundance cycle where you too will know how to navigate all these unique things. So go to moneyguy.com/resources. We have tons of free stuff to help you stay focused in these unique times on why you should be investing. And I know if you keep hanging out with us, you're going to be so successful that you'll learn, apply these concepts. You're going to reach a point that you're complicated. You can try to keep your life as simple as possible, but success will create complication. And you're going to need a co-pilot to tell you how to navigate those decisions. We will be there. Go reach out to us. You can go to moneyguy.com. You can go to aboundwealth.com. We have a work with us page. We will be that co-pilot when we're ready to take the relationship to the next level.